All right, welcome to the DeFi Report. My name is Danielle, and
I'm Farrukh.
of course, awesome to see you again, buddy. Um, so let's see, what are our topics for the DeFi Report today?
Yeah, Danielle, I think we're going to cover since still very early, it's our second episode. So we wanted to kind of talk about what's changed in student debt, right? Because we're all about student debt, and a lot has changed this year with the Trump administration coming in after the Biden administration. So we can touch upon that, and of course, the big beautiful bill. I think the name is even longer, but I'll just call it the BBB. Brought on a lot of changes. So let's discuss those. And since we're all about income sharing with at Defynance. So I think we should talk about income share agreements as well. There's lots of misperceptions out there about income share agreements. There's actually some research that has been done recently as well. So we can cover those areas and hopefully educate our listeners about both of these topics.
Absolutely. So let's go ahead and start with, I guess, what's the current student loan landscape, and let's start there.
Yeah, I think was it July 4th, right? Or right around that time when let me say it properly, the One Big Beautiful Bill Act, OBBBA, or is it OBBA? I mean, whatever it's going by, that got passed, right? So lots of changes have come in with that. And I think one of the key things that have changed, and there's a bunch of stuff, but we'll focus on sort of the federal student loan limits. So maybe you can kind of quickly cover what was happening before OBBBA and what's happening now.
Yeah, absolutely. So, I mean, there are a couple of different loan types for those who are not familiar with loans. You have the undergraduate and parent plus loans. You have graduate and graduate pl loan plus loans. You have federal or a lifetime loan limits, obviously. Um, but the main thing here are that before OBBBA, direct loans were capped at around, $5,500 to $7,500 annually and $31,000 in aggregate, depending on the student, and then 9,500 to 12.5K annually, to 57.5K aggregate for independent students. So that means that you're not dependent on your parents, but if you are dependent, you have a different loan limit. And then
Just to be clear, right, the independent student can borrow more money
yeah, that's true.
because the parent is not there to support them. I would think that's the logic.
I think that is the logic here. And then Parent Plus loans were requiring parent cosigners allowed up to the full cost of attendance. And then under this new rule that's being established, direct non-plus loans remain basically unchanged. And then Parent Plus are capped at 20K annually and 65K aggregate per student. So essentially, what it did was it raised the overall limits across the board for the undergraduate and Parent Plus loan limits. For the graduates, you had 20,500 to 130,000 and a half, up to the full cost of attendance. So I'm guessing this is per annum or per annually. This is how it was strangely structured. And then under the new OBBBA rules, grad loans are capped at 20,500 or $100,000 for your master's, and then 50 to $200,000 for professional degrees. So these would be like your PhDs, etc. And grad plus is totally eliminated. Um,
Okay, so that's a lot of stuff going on. So let's kind of break it down, right, one at a
Sure.
time. So regarding the undergraduate loans, and I think the other distinction is they're calling them direct loans now. Before they were just called Stafford loans. So
Mhm.
now the direct loans, I think they're still called Stafford, but it's like direct Stafford or something like that. So these loans are not changed. So that's the same as before. And those lending caps were there before between, like you said, 5.5 to 7.5 and an aggregate of 31,000 for dependents and 57.5 for independent students. But the parent plus loans, which actually require a parent cosigner, they were
Mhm.
also uncapped before. There was no cap on those, but now they're capped at 20,000 annually. So you can take out about 80,000 total over a 4-year degree for
Mhm.
the parent plus loans. But at the same time, I think it's also saying 65K aggregate per student. So it's not even 80K, it's 65K per student. So that's one key difference. The parent plus loans are limited. So the parent's ability to support their child's education beyond what the child could get on their own from the government is now limited, which means a parent would need to go to the private student loan market, right? And
Yeah.
we'll see how this plays out across the board. And then to get to the graduate side, there were caps of 20,500 per year, I believe, with an
Mhm.
aggregate of 138.5 for the graduate loans, and then the graduate plus loans, which were a separate type of loan beyond the, I guess, the Stafford graduate loan. There was no cap for those. But now what they've done is they've lowered the aggregate cap from 138 five and 500 down to $100,000 for a master's degree. So they've distinguished now between degree types, where before it was just graduate. Now
Mhm.
for up to a master's degree, you can borrow up to $100,000. But if you're getting a professional degree, you can go as high as $200,000. And professional degrees would be like medical degrees or law degrees and so on. I think also
Yeah.
PhD and so
Yeah.
on. And then the graduate plus loans are completely eliminated.
Mhm.
So there is no such thing as graduate plus loans going forward after the OBBBA has come into play. All right, so that's a lot that's happening there. And then they also put a lifetime limit, right? What is the lifetime limit now?
So the lifetime limit would probably be the amount of loans that they would issue to one person, probably, right?
Yeah, so
The total
any loan
aggregate,
of any type. Uh,
yeah. So anything above that, basically you would have to go get a private student loan from somewhere in order
exactly.
to finance the remaining piece.
So if
So
you're
if you,
becoming a medical student, for example, and we know medical students average around 225 to $250,000 in student loans. So if the aggregate limit is 250 and you also had to borrow while you were a bachelor student, then you certainly will need to borrow beyond the federal government to get a medical degree, for sure. Now, I remember talking to some dentists whose debt can go up to a $500,000.
yeah,
So now, they're really screwed, right? Because now with these caps, they really would have to go to the private market as the only way to borrow to get their education.
for sure.
And
That's
the
interesting.
other interesting thing is the part-time enrollment.
Yeah, for the part-time, I'm seeing here that it's eligible for full annual loan limit. So that means that though you may be a part-time student, you're still eligible for the full dollar amount.
Well, that
And
used to be the case.
that was before OBBB, and then under OBB, the lo loan limits are now prorated based on your attendance intensity. So like half-time students will get half the limit.
Yeah, so
So that
basically everything is prorated going forward with
yeah.
part-timers.
So essentially, you can't cash out and take the money and dump it somewhere. Now it's more like, okay, hey, this is what I'm getting based off of how many credits I'm taking on. So it's incentivizing students to actually go complete their education faster in some ways, but it's very
Then
minor incentive.
potentially, yeah, it is. It does give you some incentive to finish it faster, but it's still not putting any limitations based on outcome for universities. Because even if these limits are there, I guess in some ways it's possible, I suppose. Universities may, if attendance keeps dropping because of this, if
Mhm.
less people are going to college and attending universities, which is a trend is being talked about for like Gen Z, younger generation. So if that is happening, then potentially colleges may need to curb the increase of tuition costs or may even have to reduce tuition to make sure enough people are attending colleges. So I could see that potentially happening. I don't know. How do you feel about that? Do you think that's a likely scenario or is just about, hey, let's get more private institutions to come up with lending solutions so that we can still keep charging as much as we want and get people to go get the money from the private side?
I think it's the latter, right? I think that they want to make more money. I mean, like, why would they shoot themselves in the foot and like like I find it very, very unusual that they're putting these changes in now. Like if they really wanted to address this problem, they would have done it earlier, I think. Right?
Yeah,
But
I mean,
that's my thoughts on it. What's your take on it?
I mean, I think putting limits in one sense is good because it makes you now think. You
Hmm.
just can't just go borrow whatever you want to borrow and because remember, it's not just tuition, it's also cost of living. So it's about, your tuition and room and board, it's about books, it's about even your food and stuff like that, right? Like all that stuff comes into the education loans. And I think there have been stories of students that have kind of used it as their essentially their salary while they're in college. So they
Yeah.
keep getting all this free money to just, live it up while they're in college. So I think hopefully it will at least get people, students to think about it. Hey, we want to make sure that we allocate this money in the best way possible because there are limits now in terms of how much we can borrow. But again, for the students that are potentially the most immature and not that I'm saying anybody's immature, but the younger you are, the more chance that you're not as mature as you will be as you get older. There's no changes for them. Like the undergraduate stuff is not really changing. It's more the parent plus loans, and it's also
Yeah.
more the graduate stuff that's changing. So I don't know how much that's going to impact, but certainly for graduate students, it is a huge change. And I think the data that's for like some of the data we've seen going all the way back to 5 years, because I guess that data is readily available.
Mhm.
Only 3% of undergraduate students were spending more than these caps, right? So
Mhm.
it really won't impact them that much. But
Yeah.
graduate students, that number jumps up to about 38%.
Yeah, 38 to
So
40.
yeah, so that's significant because now, about 4 out of 10 graduate students potentially were spending more than these caps, and that was 5 years ago. And the cost of education is even more now. Everything is more expensive now. So I would think that number is even more high, which means that graduate students potentially will actually take on more private debt and over
Mhm.
time pay even more and end up with loans that may not be as forgiving with some provisions, for example, that are available in federal loans. So this is a danger sign, from my perspective for
Yeah.
graduate students, for people that are studying medicine, PhD, professional students.
It's preying on the people who could potentially change the world or make life better for everybody, right? You're like, that they're going to make the most, and as a result, you want to charge them the most. And I don't think that's necessarily the thing. I mean, like, would you want to have doctors, lawyers, engineers like stressed out when they're representing you in any sort of case or anything like that, or even doing a surgery? It's just like, no, no, I don't want that.
Like the
But there,
interesting thing is, like I talked to a doctor once. He did not do a fellowship because student debt was stressing him out so much that he didn't want to have another 1 or 2 years of low income before, his income exploded after he finished his medical training. So he avoided doing a fellowship, which means he potentially gave up a lot of income in the future by not specializing even more, right, as a doctor. Because the more specialized you get, the more potentially you can make it in the long term. So so some doctors are making that hard decision to give up fellowship, even though at that time they're earning a livelihood. But what if some people decide not to become doctors or lawyers or pursue further education because they don't want to take on so much more debt or be restricted to have to go to the private markets or private lenders to get the debt, right? So now we're potentially disincentivizing people to pursue graduate education.
yeah.
And that to me is not good.
I mean, one of the things that came out of the OBBA essentially doing this is that like it essentially would give institutions the power to set even lower limits for like students on a program by program basis. I think that was one of the things that we were discussing a little bit earlier, and that means that some programs could have lower or higher limits even based off of their programs now. And that was very interesting, an interesting finding that we had that we were actually discussing a little earlier today. Um, and although Pell Grants and other forms of, financing would not be really affected, but like, it's crazy that now they're deciding again, like, why are we adjusting these limits now? Is it to make it look better for like the university's numbers to look good, right? Regarding a specific field of study, right? It's like, what's the actual incentive here? Like, who's really benefiting in this scenario? Although I think from the college perspective, why wouldn't they want to just keep the rates as high as possible, borrow as much because they're going to get that money anyways? Like, I don't believe that there's any sort of real mechanism to actually monitor and see how many universities are utilizing this and adjusting the pricing of a program. Like, I don't think there's any real mechanism inside of the OBBA bill that exists.
Yeah, so just to be clear, what we're talking about is that before the OBBBA, students could take out student loans, and they had the discretion of whatever they wanted to study, and they would get the same money from student loans to be able to do that. But now, universities actually can decide how much loan students can take out for different types of programs or majors, which is, yeah, super interesting, right? Because you're putting now the power at the university level, which means universities can potentially dictate money availability for certain majors over others, so they can dissuade people from pursuing certain majors, or they can encourage people to pursue others. One rationale could be what you're saying. Maybe having more students who are engineering majors might look better for universities, for example. Or, and again, I don't want to get too deep into this because it's such a new thing. We don't
Yeah.
know how universities are gonna, what they're gonna do with this, right? And it's super interesting how this type of a provision is in there, and I'm still trying to get my head around as to why this was put in there in the first place.
Yeah,
So I think we need to do some more research on this, some more thinking about this, and we can maybe dig deeper in a future episode. But it's just a
absolutely.
very interesting thing that is there. And the other thing you mentioned that was super important is that Pell Grants are not changing. So that's not, you can, if you are low income, you can still qualify for Pell Grants, which are 100% free money. That it doesn't
Yeah.
have to be repaid. And so that's still available to people that, are in the lower, even to Pell Grants are available to people even in the middle income brackets as well. But the amount of Pell Grants available gets less and less the more household income there is. So that is still available to students to avoid student debt completely, and scholarships as well.
Yeah. I wanted to shift gears for a little bit. I wanted to see a little bit more about like how do ISAs fare? I guess maybe we educate the audience a little bit more about what ISAs can actually do in this particular scenario.
Yeah, of course. And ISAs, for those that don't know, stand for income share agreements or income sharing agreements. And since the Biden administration, which came down on an ISA provider, mainly about the type of disclosures they were giving to consumers. So
Mhm.
the CFPB, the Consumer Financial Protection Bureau, they made the determination that ISAs are another form of loans. And as somebody in the space who understands what ISAs are, I don't agree with that, but we have to follow the rules. And if that's what the government is saying, that's what they think they are, then we have to follow the rules. So what they want to do is they want ISA providers to issue TILA disclosures, truth in lending disclosures. Now, right there, right, like a pure ISA is not lending as far as I'm concerned. But anyway, if that's the rule, then the ISA organization, their disclosures did not match the truth in lending type of disclosures. So the CFPB came down on them and required them to change their disclosures and so on. But the interesting thing is that they didn't ban ISAs. They didn't even find this organization. They didn't even um, come down on them from an ECOA perspective, because ECOA stands for, I think, Equal Credit and
Credit.
Opportunity Act, right? To make sure that there's no discrimination when you're issuing credit. Like in the old days, there was redlining for African Americans not to buy houses in certain neighborhoods and so on. So, which also is a positive thing as far as I'm concerned, because they didn't find any issues regarding equal credit opportunity. with regards to ISAs or ISA providers. So they didn't really come down on that issue at all. They just focus on the disclosure issue and to make the disclosures look more like lending disclosures because they wanted like APRs to be disclosed. And APR is an annual percentage rate, which includes the interest rate and all the fees and other costs of financing or loans, all wrapped up into one. To kind of give an apples to apples comparison. But because income share agreements are all about sharing income, so that can fluctuate if income can goes up or down. So
Yeah.
sometimes the APR is not as good of an apples to apple comparison against a loan with the income and share agreement, but that's the way it has to be done now, and that's the way I think everybody's doing it, including what we're doing. But I'm
Mhm.
just giving a long-winded answer. So let's
Yeah.
go back to your
I,
main
I
question.
know,
What is an income share agreement? So I kind of got into some of the
yeah,
weeds.
but the nice thing that I was saying about the ISA is that like essentially because of it is income based, when you don't have any income, like payments do stop. And
Yeah, yeah,
that's the beauty.
absolutely. It's an income sharing agreement, which means you're sharing income. So if you don't have income, there's nothing to share. So
Yeah,
the payments will pause. In
yeah,
fact, in our ISA program, payments pause even if your income decreases substantially. So we would pause the payment, and that really is a safety net for the consumer because if income drops, you don't have to make the ISA payment. Well, that doesn't apply for your mortgage payment. That doesn't apply for your rent payment. That doesn't apply for your car payment. Doesn't apply for your utilities and your cell phone bills. So those folks are not stopping there or pausing the payments because you're running into financial hardship, but an ISA provider would, because that's just the structure of how the ISA works, which means then that person has the ability to pay some other bills or allocate some of the money that what they were allocating for income sharing to other areas. And then once their income comes back on track, once they find their next job or whatever financial hardship they were in passes, then the ISA continues and then they can finish it in whatever term the ISA was all about. So that's how it works, and of course the income fluctuates. So as you're earning more income, your payment also increases, but the sharing percentage does not change. So if the sharing percentage is 5% of income sharing, then that remains. But I think from an affordability perspective, it also, is very, very good in that sense because from a budget perspective that you have to share this percentage of your income no matter what happens. So that way you can always budget for that and always stay on track. So I hope that's what you were trying to get at.
yeah. That's what I was trying to get to. But I actually wanted to lead into another thing, which was like you actually had a conversation with an ISA specialist earlier, I think last week it was,
Yeah,
right? And you had some interesting insights that came out of that conversation. Maybe you can share a little bit of that with the audience here.
yeah, sure. I mean, we talked about a bunch of different things, and obviously, as an ISA provider, I'm always interested in terms of what's going on from a regulatory perspective. And I think some of the key insights that we discussed were there's actually now ISA laws are starting to be codified. In fact, this gentleman is working on the bill that's in Congress, both at the Senate and the House level, and it is being sponsored by bipartisan support, meaning from both sides of the aisle, Republicans and Democrats. So that's awesome. And he feels like, this is the closest that the ISA industry has been to get this bill, in front of both the House and the Senate to actually get it converted into or passed into a law. So let's see what happens and if when that happens. But of course, there's a push to make that happen because that will bring more certainty from all sides. But on the state level, there's already more certainty because now, for example, the state of Illinois has passed an ISA law, and other states are also contemplating it. So more stuff is going to come out. So at least there's now precedent on the state level, and hopefully the federal level is going to come out too. So that was one interesting thing we discussed. And the other thing was what I talked about earlier about the CFPB, and I think his direct quote was, or I'm paraphrasing, if they really wanted to put ISAs out of business, they would have thrown the book at that company that they were dealing with, the ISA providers, and they didn't. So in fact, there was not even a fine It was just about changing your disclosures and all that stuff, right? So that was the CFPB action that happened, which is a clear indication that regulators are not saying that ISAs are illegal or whatever. They just view them as loans, so they want to regulate them as loans. So until that changes, until the ISA bill becomes law, which will treat them as a separate financing instrument, not as a loan, then we will have, more clarity. But until then, we still have clarity because now we just treat them as loans and we do the disclosures like they want us to do and so on. And we still can do the ISA the way it's supposed to be structured, which is based on income sharing. So as a practitioner, I mean, I feel better than I did even 3, 4 years ago when we started working on this, because then I think it was a little bit more of the wild, wild west. There was much less movement on the regulatory side, and the concept was more newer. A lot of people were exploring it, but now there is a lot more. There's a lot more certainty for sure. But the other thing that's interesting, Danielle, is to going back to the what the OBBBA did is the statistics show that about 12% of students spent more than the OBBBA limits back in 2019, 2020, right there from the data that we were able
Mhm.
to see, which means that 10% of the federal student loan um, burden, so to speak, or student loans would be shifting over to the private side. So the private student loan is about 10% of the overall student loans. So of the 1.8 trillion private student loans, I think about 9 or 10%, like about 140, 150 billion dollars. But if another 10, 12% are going to be over the limits on the OBBA, then that means the private side is going to double essentially. I mean, we're going to have about potentially 300 to 400 billion dollars of private student loans, which is more of an opportunity for Defynance, for income share agreements to play their part to offer a better solution versus lending. And also other lenders will also have an opportunity to grow that side of the market. So that's pretty significant. The potentially the private student loan market may be doubling in size when the OBB goes into effect, which would be for the 2026, 2027 school year.
Okay. That's awesome. That's awesome. Anything else on your mind?
Yeah, I think one more thing. I saw some research recently about the Purdue backup boiler program, which was, I would say, the featured program, ISA program in the country for a while, because Purdue University, as we all know, is a major university in the country, and they had an ISA program called backup boiler, and
Mhm.
it was paused in 2023, I believe. So it was a couple of years ago, but it ran from 2016. So there's about 7 to 8 years where the program ran, and it may come back in the future. It's technically paused, but there was some research done. Purdue University did research with Jobs for the Future. It's a nonprofit organization that does research on income share agreements and workforce development. And the research actually is very encouraging.
Mhm.
So one of the things they talk about is about 60 to 70% of backup boiler students, meaning students who took the income share agreement or ISA from Purdue University, actually paid less with the ISA versus the loan. So, because again, one of the criticisms is because it's income sharing, that just people automatically assume you're going to pay more.
Yeah.
But that's if the program is designed well, it may not be that way. And really, they're comparing this against a Parent Plus loan because
Mhm.
the backup boiler, I think was, if I remember correctly, was the financing of last resort at Purdue. Like once you were exhausted everything else, then this
Yeah.
would come into play. So compare against a Parent Plus program, it was about 50 to 70% of students paid less. And it also confirmed that lower earning students paid less with the ISA, which makes sense. Income is lower, you're going to pay less, and that potentially higher earning students were likely to repay more. So again, it confirms how the ISA typically does work.
Yeah.
But the other very interesting thing is that because we see that student loans disproportionately impact minority students. And there's clear statistics about this, whether it comes to Black students or Hispanic students, that they are more disproportionately affected by student loans. But the research shows that Black and Hispanic students were not financially disadvantaged with an ISA. And actually, the program improved completion rates, especially for Black and Hispanic students. So
Hmm.
that to me is super encouraging because, if the minority students are getting into more debt or getting into more problems with student debt, which means less of them are completing, a lot of them are coming potentially from immigrant families, especially for Hispanics, other immigrant communities as well, and um, lower income earners as well, because typically Black and Hispanics earn less than the average American, which means they may have access to less co-signers as well. So many different issues that they're dealing with on the student loan side. But on the ISA side, it's good to see that the leading ISA program for many years actually showed that these types of people were not disadvantaged. In fact, the ISA was a good thing for them. So I'm super encouraged, and I really strongly believe that this is the case for a good, well-designed ISA program. And we feel like at Defynance, we have an extremely well-designed ISA program that should be fair and just for pretty much everybody.
Yeah. I mean, I was reading here, there was a line inside of the research that we were looking at. The research suggests that the critics' concerns so far have not come to pass and that the program has been moderately successful in serving students with a more affordable and accessible financial alternative to Parent Plus loans. And that leads to our Definance conversation, right? Where the Definance ISA can essentially do the same thing, but even at bigger
Absolutely. Absolutely. And even with the Defynance ISA, and we can't get into it yet because we're still working on the development of this, but we want to expand the Defynance ISA in the next, um, let's say the beginning of next year, to be even more comprehensive, to give more options to students, sorry, to graduates, income earners who want to refinance their student loans, and actually potentially to even parents as an alternative to parent plus loan, which is getting limits now where it never had limits before, meaning more parents will have to go to the private side. So as a company, we want to be there to give them a good alternative as well with an income share agreement, the Defynance ISA.
Hmm.
All
All
right,
right.
so I think we've covered pretty much everything we wanted to touch upon. And next week, we'll be back and we'll talk more about what's going on in the student debt space and the ISA space and a bunch of other things that we kind of look at, monitor on a regular basis.
Yeah, for sure. Definitely. And I think today's pod was awesome, right? Hopefully, the audience got a chance to learn something about ISAs. An example ISA that was just recently completed and some analysis done on the back end, and learned that, hey, that the OBB actually gave an opportunity for students to go out and take these potentially, hopefully cheaper and lower amount loans that allow them to pursue their education. And we'll see the outcome of this in the next coming months, if not years. But I think that covers the DeFi report for this week. Well,
Yeah,
I think
absolutely. Keep listening, comment, let us know what you thought about this. If there's any questions you want us to address, any topics you want us to address, please do comment and we will do our best to address them. And look forward to continuing next week with you, Daniel.
absolutely. It was a pleasure.
Thank you.
Okay. Thank you, everybody.